today we're going to hear from Dana Samuelson, who's been in the gold and silver business for over 40 years. Not only that, he's an expert in macroeconomics and really going to help show us how the macroeconomics and the dollar tie together with gold prices and the Federal Reserve. I know it's a lot to digest, but stick with us and you'll learn a lot. Hello, welcome to another show, CSQ Properties. Excited for our guest here, Dana Samuelson. Dana, thanks for joining the show.
Hi, Chad. My pleasure. Always good to be with you.
Yeah, so you actually hold two records. I know you know of one. The most amount of views on the YouTube channel for CSQ Properties. You hold that title for the most number of views.
Wow.
But what you probably don't know is that you're also the first guest I've had on twice.
Oh, wow. Wow.
Yeah.
Well, I'm flattered. So thank you. Thank you.
Well, it was great last time. We really dove into the economics of things. We're going to do that a bit more today, which is great because so much has transpired since the last time we talked. You do a great job of putting together a presentation on the macroeconomics and how it affects the dollar and gold. And frankly, no one's got as much gold experience as you. So really excited for today. And just wanted to publicly thank you for putting all the time into the charts that you do. I know you customized this for our audience. I really appreciate that. And with that, why don't you introduce yourself a little bit more for those that are watching us for the first time? They can learn about you and tell us about what you do and a little bit about your background.
Well, thank you. So I'm a precious metals and vintage rare coin expert. I've been doing this since 1980. This is my 43rd year. It's all I've done since I got out of college. So I've painted myself into a little golden corner. It's all I do well. But I focus very, very much on running American Gold Exchange, which is my national mail order precious metal and vintage rare coin business. It's our 25th year. We're out of Austin, Texas. So we buy and sell physical precious metals and pre-1933 U.S. gold coins primarily. And I've got an impeccable national reputation for business, integrity, transparency, competitive pricing. So just try to help people in the physical precious metals sphere. I'm father, got a 5-year-old daughter at home, so I know you have young kids at home. So we have some notes we can share there. Got a 10-year-old that I've inherited, so I have a blended family, and very happy to be doing that. And I'm not quite the youngest man on the planet, so it's a challenge.
Yeah, well, you and I officially joined the old dads club. I got a 1.5-year-old at home now, and a 3 and a 6 and a 13 and a 17. So I definitely started a little bit before you, but I think I'm going to end after you as well. But it is officially the old dads club. I think if you have a kid after above 40, I think that's the official old dads club. So we're both in there. But great to have you on the show again. Really appreciate it, Dana. What I was hoping we could do is maybe dive into your presentation a little bit. I'll let you do most of the talking. You're the expert in this area, and I will chime in with a few questions here and there. I'll give a brief kind of warning to the audience. We're going to see a lot of charts, a lot of data, a lot of information. Stick with us because we're going to bring this thing all full circle on what it means for the dollar and some of the geopolitical issues that we're having in the United States. So stick with us through the charts. You'll learn a lot of information. There will be replays of this, so you can watch it again. It will maybe take 2 or 3 times to understand some of this stuff if you're seeing it for the first time. But I guarantee you'll learn a lot. So Dana, take us away.
Okay, so this is our company information. This is how you reach us. So the last time we talked, Chad, we talked pretty much about inflation because inflation had reared its ugly head, and we discussed how there were 3 big waves of inflation starting in the late 60s that went all the way to the 1980s, and what the potential ramifications were for this cycle based on what happened the last time, which is the last major inflationary cycle that we've had. So this is a chart of headline and core consumer price index going back to 2000. As you can see, inflation is coming down with headline dropping sharply over the last 3, 4, 5 months. But the core inflation is holding up a little bit better, and it's holding up higher now than the headline inflation. And that's pretty much because energy has dropped over the last month or two and brought what I would call sticky inflation or core inflation is holding up higher. And the whole point of this is what the Fed is reacting to with their sharp interest rate hikes, trying to stem inflation in this first wave that we're in now, because they learned that if they don't get it in this first wave, like they didn't in the late 60s, we could have further inflation in the future, which could be worse. So that's why they're trying to snuff it out now. I do think the Fed's target of 2% is too low. I think the basal rate or the base rate of inflation is going to hold up higher, probably between 3 and 4%, and that's where we're going to have to live with, for the next couple of years. I think that's really where the base case is going to be. But we'll see. And that's barring a major economic slowdown, which is possible. And that's part of why the Fed is raising rates as much as they are, is to slow the economy down so demand falls and prices fall and inflation will come down further. So here's a 15-year chart of both the 30-year Treasury bill yield, which is the red and black line, and then the federal funds rate in the black at the bottom of the chart. You can see how for years between 2009 and 2016, the federal funds rate was zero. I mean, that was the period of easy money, where money was cheap. To get a mortgage was 3%, 3.5%. If you refinance properties, yields held up above that, and that's a 30-year yield. At average rate of about 3.25%, 3.5% over most of this time. When the Fed went through the last rate hike cycle between 2016 and 2018, they only got to 2.5% before a global economic slowdown caused them to drop rates, and then we got hit by COVID, which is why we went back to zero. The Fed completely mismanaged COVID the economic closures of COVID by overstimulating. They put too much money into the system, which spurred inflation. They were late to react to that inflationary burst, and now they're reacting sharply, as you can see on the right-hand side, how high they've and how fast they've risen, made the Fed funds rate go up, which is now at about 4.75 points, and they may not quite be done yet. But this is the fastest, highest rate hike cycle we've had in decades. And what it's done is it's raised all the yields on the treasuries. This is a chart of the 2-year treasury yield, the 10, the 20, and the 30. So it's a little bit more in depth, but you can see yields were under 2%, going into 2020, into 2021. And now with this Fed rate hike cycle, they've all surged higher to almost all of them over 3.5% now. So interest, the cost of interest, and you're in the real estate market, that the rate of interest on mortgages have doubled over the last year because of this rate hike cycle. And all of this is to slow the economy down. And what points to that more than anything else is an inversion between the 10-year treasury yield and a 2-year treasury yield. This is a very consistent leading indicator of a recession to come. Well, we haven't gotten there yet. And the reason is because the economy has proven to be more resilient than we might have expected. Over the last 6 months, we've seen employment's remained good. Consumer spending has remained pretty good. And our economy is 70% based on consumer spending. But here's the rub. We have seen the savings rate drop to record lows over the last 6 months, and credit card debt moved to the highest level it's been ever in the last 6 months, and it's widening the space between how low savings has gone and how high credit card debt has gone. So consumers have tapped out their savings accounts, and they've leaned on their credit cards to supplement their spending ability in the face of the higher cost of goods and services that we're all being forced to pay right now because of the inflation that we're going through. Now, it's kind of ironic that the Fed, in trying to save 5 or 10 million jobs through the stimulation that they did during COVID, has cost 180 to 300 million of us a much higher cost of living, with inflation going from 2% to over 9% at one point in time. Now it's about 5%. So the Fed has mismanaged their mandate completely in terms of what we all pay for financial stability. Employment remains good, but employment is literally the last thing to go. So let's talk about the economic cycle a little bit. And I do think we're headed into a slowdown. Most of the major indicators are pointing to that, although we haven't gotten there yet. So when you raise interest rates as much as the Fed already has, this is how it affects the economic cycle. And the acronym would be HOPE, HOPE. The first thing to react is housing, because the cost of mortgages rises. And we've already seen that. Housing sales have slowed down a lot. Prices have dropped. Sellers are reticent to drop the sales price, and buyers can't afford the same house that they could afford a year ago because the mortgage rates are double. So housing is first affected by higher interest rates. Then manufacturing slows. Orders slow down as the consumer starts to buy less. And that's what we're seeing now. We're starting to see manufacturing slow materially. If you look around at some of the manufacturing indexes around the country, the Philly Fed manufacturing index, the ISM purchasing managers index, we're seeing orders are slowing down. What follows then, profits fall as the orders decrease. So right now we're in between the O and the P of this cycle, I think. And what happens last is employment falls. So first you lose housing, weakens, then orders fall, then profits decline, and then employment starts to fall. So employment is literally the last thing to fall when we go through an economic cycle that changes or decreases because of rising interest rates. And the lag between the start of this for housing to react and employment to react is anywhere between 12 and 24 months. And we're in about 12 months, the 12th month of the cycle right now. Excuse me. So the Fed, when they focus on employment, they're looking in the rear view mirror. And what's a little bit unusual about the cycle that we're going through right now is that business owners have had a hard time hiring employees and keeping them over the last year or two. So they're hoarding employees right now. And we measure that through hourly productivity. And the productivity level of workers has fallen about an hour a week over the last year. Now, it doesn't seem like much, but what that really means is they're keeping workers that they might normally let go in an environment that's easier to replace people in. So we haven't really seen employment fall like it could, but if you look at an employment chart compared to recessions over the last 3 or 4 recessionary cycles, you'll see that employment always tends to peak just before a recession really hits. And right now, employment is peaking. So I do think we're on the cusp of a real economic slowdown. How severe it will be, we don't know. But I'm not the first person to say this. Economists have been predicting this for months now, and it's just taking longer to materialize. So I think we're going to see that happen. I think if you're in the real estate market, you're going to see better prices for both individual single-family homes and multifamily going into the next 6 months or a year. And if the Fed is forced to cut rates, you'll see lower mortgage costs as well. So I think we're going to get a real buying opportunity in real estate, but we're going to have to be patient because it's going to be a little while before we get the full effects of that.
Yeah, one thing, just a note on that, Dana, with the with the single family housing, I think we are in an interesting conundrum right now because you've got over half of the single family residences with less than a 3.5% mortgage right now nationwide. And so people, if they're already in a house, they really don't want to move, right? Because their mortgage, their interest rate's going to virtually double on a new house. And I think that's part of the reason why we've been seeing inventory so low, at least on the market, is because these homeowners want to sit. And as you know, when we have lower inventory and lower supply, and you still have some demand there, there's actually still higher demand than what we've got for supply. That's forcing pricing to go up in the single family market on top of the interest rate. So it's really a unique, I think, position that we haven't been in before in the single family space. I follow the single family space closely because that trickles down into the multifamily space, right? If people can't afford houses, they wind up renting longer, and then that's becomes my customer on the multifamily side. So any thoughts on where we might go in terms of looking at housing in terms of single family houses? If interest rates stay high, what that might do on the supply side with people just kind of sitting it out in their 30-year mortgages?
Well, you make a perfect point, and it makes perfect sense. Why would you want to trade into unless you really want to downsize, why would you want to get a smaller house? Because that's what a higher mortgage rate is going to get you
Yeah.
if you wanted to trade out now. But what happens when employment falls, which is the last part of the cycle, then you have sellers that don't have a choice. They're forced to sell. And that might help to bring supply into the marketplace. We don't, we'll have to wait and see, but that's typically how it goes.
Okay.
Right? So as long as people have jobs and they can cover the mortgage, you don't get that forced selling of their individual homes. But that is what happens when unemployment rises. You'll start to see forced selling.
Okay.
So we'll have to see how that plays out this time. But you're right. This is kind of a conundrum as far as what the normal economic cycle is. It's not quite the way it normally has gone in the past.
Sure.
Which is confusing. It's confusing to economists and to the public at large. So, that's why I follow all this stuff to try and stay up on it. And, things change month to month. So we try and focus on the bigger picture. So I'm a precious metals guy. That's really my forte. And one of the things that you asked about, that you wanted me to talk about, was what's happening in the precious metals cycle. So let's switch gears over to that now. And one of the things that you asked, Chad, was, are central banks buying gold? And they are. So this is a chart that goes back to the 1950s that shows central banks' net purchasing and net sales of gold over the last, 72 years, basically. And for most of that time, central banks have been net sellers of gold. During the late 60s, when it was clear that the U.S. was spending more money because of the Lyndon Johnson's guns and butter, Medicare and Medicaid programs, and the Vietnam War, gold was leaving the U.S. at quite a rate. And that's what took us off the gold backing of the dollar in 1971. Nixon was forced to do that. Well, most of the time, central banks have been net sellers of gold, but we've seen a distinct and dramatic change in central bank gold selling into gold buying starting on the heels of the great financial crisis in 2010 and 11. Central banks have been consistently net buyers of gold for the last 12 years, and that trend continues this year. In fact, the last quarter of 2022 was record gold buying among central banks. This is an annual chart. I don't have a quarterly chart. But that's because, we continue to see our debt just explode globally, not only here in the U.S., but globally. This is a chart of global debt going from 2014 through 2022. And you can see at the beginning of this time frame, global debt was $220 trillion, and it's gone up another, 50% since then to $370 $365 trillion. So central banks are printing money out of thin air around the world, and they're diluting the purchasing power of fiat currency. And central banks, I believe, are buying gold at a record rate to hedge their own bets against their own trading partners by buying other countries' treasuries, specifically U.S. treasuries in particular, or currency trading. I mean, we've seen currencies that are on the verge of failing around the world recently. Venezuela is one. Argentina just introduced a 2,000 peso note for the first time ever. The largest note previously was a 1,000 peso note. But inflation in Argentina is so high right now, they doubled the size of the note from 1,000 pesos to 2,000 pesos. And even a 2,000 peso note is only worth about $4 today.
Wow.
So that's why central banks, I believe, are buying gold at a record rate. Now, there may be something else afoot as far as de-dollarization, which we'll talk about in a little bit as well, that has something to do with that. But there's also been a strategic change in assets, where gold was elevated from a tier 3 asset to a tier 1 asset, which means banks can carry gold on their books as a no-risk asset, where they used to carry treasuries or cash. So that may be contributing dramatically to the appetite central banks have to have gold on their books as an asset in the tier 1 category. So
do you know when
that's
that
important.
went into effect?
2020, I believe. I may be off
Okay.
a little bit on it,
I
but
mean, that
that's a
sounds
new
like a pretty big
development.
deal.
It is a big deal, and that's helped to contribute to, gold being bought up by central banks. But the U.S. we increased our debt here in the U.S. $6 trillion in the last 2 years. I've said this before. Between 1795 and 1995, 200 years, we accumulated $5 trillion in debt. And since 1995 to now, 28 years later, we've multiplied that debt over 6 times to 31, almost $32 trillion.
Yeah.
And the rest of the
Jeez.
world sees this. And that's why gold continues to set higher highs and higher lows. And why central banks around the world are buying gold, because what happens if the U.S. defaults fundamentally, or we mismanage our finances to the degree where the dollar becomes worthless? I mean, that's where we're headed over the longer term. We cannot sustain the pace that we're at, and we're going through a debt ceiling fight right now, as people are aware of. So that's a whole nother topic and a rabbit hole we can go down. But this is why gold is in favor. And here's a long-term gold chart going back to 2004. It's a 20-year gold chart. And you can see that it's lumpy, but the trend is up, and the big eras that we've gone through, based on the price chart from 500 to 1,050 to 1,550 to 1,900. The big point here is gold is setting higher highs and higher lows. The previous high was 1,050. That moved up to 1,900. Then that became support. 1,050 became support. Now we've gone up to 2,055, 2,070, and support is holding at about 1,650. And I think gold is getting ready to make the next leg up over the next couple of years. And I think actually we're in a very fundamental setup for that to happen, for gold to go to the $2,100, $2,200, $2,300 level, maybe even higher. And it's not so much that gold is gaining in value. It's that the dollar continues to lose purchasing power. That's really how you need to look at this. The dollar is losing purchasing power every year. The more debt that we accumulate, the less the dollar will buy. And that's really what this is all about. That's why real estate prices are actually doing fairly well. They're a good inflationary hedge. When inflation's 2% a year, like it was for most of the teens, we really don't feel inflation. But when we get an inflationary surge and we all get a 7, 8, 9% purchasing power haircut, like we got last year, suddenly we all feel it.
Yep.
And that's what's going on. So it's not that gold is getting that much more valuable, it's that the dollar is losing purchasing power. So this is why I really think gold is setting up for a much higher move. And it's because gold tends to move inversely to both the dollar and treasury bill yields. And that's what this chart illustrates. If we go back 17 years to just before the financial crisis, you could see that a 10-year treasury bill yielded about 5.2%. And as the financial crisis unfolded, that yield fell all the way down to 1.4%. Well, gold went from about $1,000 to $1,900 during that drop in yields. Then, as the financial crisis stabilized and the economies of the world started to get traction, that yield rose back up to about 3%, and gold fell to about $1,200. For the next 4, 5, 6 years, gold channeled, like the treasury yields, channeled between about 1.75% and 3%. Gold channeled between 1050 and 1375. And then in the middle of 2018, before the Fed started to cut the funds rate in the summer of 2019, yields fell again. And gold ran from 1185 all the way to about 1600. And then COVID hit and yields fell to zero again. And gold hit 2070. Then over the last year or two, we've seen the Fed raise rates at the fastest rate ever. And yields have risen dramatically. And gold fell from 2070 to about 1635. But over the last 6 months, a little bit longer, 8 months, gold has made a big run back to over 2000 to as high as 2055 as yields have come down a bit. Now look at this chart, just put it into perspective. Yields now are the highest they have been since 2008 and 10. And gold is not at $1,100, $1,200 an ounce. It's at close to $2,000 an ounce. It's about $1,970 today. Yields have a long way to fall. And that's what's going to give gold a real tailwind. And that's why I think gold is in the perfect setup for a pretty big rally going forward if yields do what I think they're going to do because of an economic slowdown. Now let's just drill down just a little bit more. Now we've added the federal funds rate to the same chart and changes the scale a little bit. But you can see how the Fed funds rate back in 2008 was about the same as the 10-year yield at 5.2%. It dropped all the way to zero. They got to 2.5% in 2018 into 2019, and then they've cut on a global economic slowdown to about 1.7%, and then COVID came and they dropped back down to zero. Now they've raised rates all the way back to almost 5%. And we might get another quarter point rate hike out of the Fed before this rate hike cycle is over. I don't think we're going to get it at the end of the June meeting. We might, but inflation's, if it stays sticky, they might raise rates maybe one more time. That's what I think. We'll have to see, but they want to see what happens with the hikes they've already done. And I think that they will go to a pause and hold rates at this level probably for longer than they should, because they do want to snuff out inflation. But what they may also snuff out in the process is the U.S. economy. And they may overreact to the wrong side, like they've overreacted twice to the wrong side of this whole equation. So if they do that and the economy slows quite a bit, yields could fall. And then if the Fed is forced to react and cut rates sharply to stimulate the economy, that gives gold even more explosive upside potential. So I really think gold has got potentially a lot of tailwinds going forward. And it's not going to happen fast. It could take 3-6 months before this whole process really gets started. But over the next 2 or 3 years, gold can make some really big gains for these very reasons. And
And
let's
all
just
of
look
this
at it.
doesn't even account for any de-dollarization yet, right?
Right, exactly. So this is a little bit deeper drill down, and this is the gold chart. So basically, if we just go back, the gold chart's going to be pretty much an inversion of the chart that we just showed you. And that's what it is. So this is a little bit more parsing on the gold chart where you can see how when yields fall, gold rises. When yields rise, gold falls. But now yields are as high as they've been in a long time, and they've got a lot of room to drop. And if the economy goes into a slowdown like I think that it could, and it probably will, it all depends on how deep or mild a recession is and how long it persists and how the Fed reacts to it. That's really the key to all of this. And again, like I said in our last interview, inflation just continues to drive the bus here, and the Fed's just reacting to it. So very quickly, part of what I also do is I drill down on this on a much more nuanced level. This is a one-year gold chart. Right now, gold's made a big move up from the bottom it hit last fall at $16.35 an ounce, which was due to rising yields and an abnormally strong dollar. As the dollar weakened, gold rebounded, and then as yields fell, gold surged higher. And then, of course, the SVB Bank, when it failed, yields fell because there was a rush into treasuries as a safe haven, and gold caught a bid. And now gold is basing at around 1970 an ounce. It's correcting a little bit. I do think it's going to hold the support at 1950. Below that, gold has support at 1900. So I think, if you can buy it around 1950, 1960, that's a great deal right now. If it drops a little further, that's just going to make it a bit more of a buying opportunity. Same thing in silver. We follow silver very closely as well. Silver was down to about $18 on a low. Then it's been all the way as high as 26 and a quarter. And right now it's about 23.50. So it's backfilling a little bit. It's made a big run. In the big picture, gold is at an all-time high or close to it, where silver is only half of its previous high from 1980 and from 2011. So silver has much more upside potential than gold. It tends to lag, but when it plays catch-up, it plays catch-up pretty hard. And that's what it's done over the last 6-8 months, is play catch-up percentage-wise to a greater degree than gold has. So silver lags and then follows, but it follows with a vengeance when it runs. And I think if gold goes to 2400, silver has potential to go back to $45 an ounce, maybe even a little higher. So the metals are looking pretty good to me. Yeah.
A question for you, Dana. On both these charts, the gold and the silver 1 years, we've got two inversions happening with the 50-day moving average and the 200-day moving average. Is there any takeaways you have for that? They're both showing that inverted twice.
Yeah. So when the 50-day crosses under the 200-day, they call that a death cross. And that means the market's in a confirmed decline. And you can see that happening on the gold chart here. On the left-hand side, it's covered over by the word strong dollar.
Yep.
And then if you go over to the right-hand side of the chart and you go to just above the word weak dollar, the 50-day moves back over the 200-day moving average. The 50-day is the light blue line, and the 200-day is the light red line. That's called a golden cross. And we use this as a classic long-term indicator for rising or falling any particular value, whether it's a stock or a commodity or the dollar. This is what we look at. So yeah, that's gone from a very bearish signal when the 50-day went under the 200-day, and it confirmed a bottom, and then now we've got a rising trend again with the golden cross. So that's a good pointing that out, Chad. Thank you. And it's the same on silver here, where we went under and then over with the 50-day over the 200-day average. So that's a very bullish sign, and we got a wide spread between the two averages right now.
Okay.
So that leads us to the dollar. And I've talked about how the dollar's losing its purchasing power. But there's been a big movement in the last couple of months towards this whole thing called de-dollarization. And what's happening are countries around the world are starting to shun the dollar in favor of direct currency transactions with their other individual trading partners. Most famously, Saudi Arabia has decided to accept payment in currencies other than dollars for oil sales, specifically with China and Russia. So Saudi Arabia is going to take payment in other currencies, which they haven't done since the 70s when we set up the petrodollar under Henry Kissinger, where the U.S. agreed to protect Saudi Arabia if they would price their oil internationally in dollars. And now we've seen a big reversal of that trend. On top of that, we've got geopolitical problems with the war in the Ukraine, where Russia has been sanctioned, and we weaponized the dollar by taking Russia off of the SWIFT international bank transfer of payment system that's used internationally. China is basically quietly siding with Russia in the war against the war in Ukraine. And we're seeing a bifurcation now geopolitically between the East and the West. And announcements where countries are deciding to take payment in Chinese yuan instead of dollars, which were the intermediary currency. So Brazil in particular is taking Chinese yuan in exchange for Brazil reals in direct trade with China. Now that works between these two countries because their trade balance of imports and exports is pretty close to being the same, where you don't see one of these two countries, Brazil and China, piling up a reserve where one is selling more to the other and getting too much currency. Now that's one of the reasons the dollar has been one of the best examples of world's reserve currency over the last 50, 60 years, because we can export dollars in the form of selling our treasuries, which subsidizes our debt as foreigners take our dollars, but then we buy them back when we consume goods and services. So that's a good two-way movement of dollars out, debt, and then back in for televisions and toaster ovens. But the thing that really makes a world reserve currency function, there's 5 components, and that's what they are on this slide here. The economy has to be open to the ebbs and flows of international trade and foreign investment, which the U.S. is. The Eurozone is as well. China is not. China has currency controls. So they don't let the yuan just go in and out of the country at will. You have to have a liquid bond market that's open to foreign participation. Well, we've had that for years. So that's a functioning debt market where the market sets the yields or the value of that debt. You have to have acceptance of exchange rates set by market forces. And we've seen that across the world with the value of the dollar going up and down against the euro. Now, the Chinese yuan is basically pegged to the dollar with a small float up and down against what the Chinese have it pegged at. So again, China is the second largest economy. And they're really the only ones that can challenge us for world reserve currency status. But they don't have a free-floating exchange rate. And there's not
like a really tall. This is sounding like a really tall order for China to be able to take over as the world reserve currency.
It is, but we've got a little bit more to talk about. But you're right. So, and then you have to have an uninhibited bidirectional flow of currency. That's currency going in and out, right? And as you get too much of a currency or too little of a currency, well, you pay more or less for that currency. That's why exchange rates go up and down. And that's what free markets are all about. And then you've got to have political governance and financial regulation so that we know that there are some rules on top of all this that everybody has to abide by. And China has a command and control economy. If they decide they want to do something, they're going to do it. So what's going to happen over the next few years is we're going to see more and more countries doing direct trade with other countries outside of the dollar. So the dollar was about 70% of the world's trading volume at the turn of this century internationally. Now it's about 47, 48%. So we've seen the amount of dollars required for international trade diminish over the last 23 years. That's going to continue. I don't think that there's going to be one single currency that's going to knock off the dollar in the short term. But we could see the dollar lose influence over the next 5 or so years by death of 1,000 little cuts, which is what's already starting now. Right? You've got a lot of Asian countries are starting to trade amongst themselves outside of the dollar, and that's a trend that's going to continue. So, the dollar's not going to get knocked off easy. And what world reserve currency status really means is not economics, it's power. And we've, for the first time recently, exerted that power with our sanctions against Russia for their bad behavior in the Ukraine. And China doesn't like it. Russia doesn't like it. Some of the other countries that are aligned with China and Russia don't like it. Saudi Arabia, we've alienated over the death of a journalist. And that's a major trading partner for us. And now we've got MBS coming up there. So we're seeing some big changes. And this is going to continue. Now, really, the only thing that could change this is if the Chinese were to suddenly say, hey, look, we've got 15,000 tons of gold, 20,000 tons of gold, 25,000 tons of gold, and we're going to partially back the yuan with gold to give you that comfort level that you don't get with a bond market or exchange rates that are floating or a bidirectional flow of currency. I mean, that's a possibility. But they'd have to show the world that they really have the gold, and they might. The U.S. has 8,000 tons.
Well, I was going to say, won't the U.S. have to do the same? Won't they actually have to prove that we have 8,000 tons as well?
Well, I think we actually do. I think that gold is actually in Fort Knox.
Okay.
But I don't think, there's been some talk of a, multi-country based, commodity-based currency based on oil and natural resources. I think that's kind of pie in the sky thinking. It sounds great, but in practicality, it's virtually impossible. The euro was first conceived in the 70s, and they didn't really deploy it until 1999. It took 25 years from conception to birth. And now It's got problems because, there's unevenness amongst the Eurozone countries. We've had the Greece debt problems. We've got an Italian debt problem. I mean, it's barely held together. And that's been in a free market system. If you think 10 or 15 countries are going to agree that this is how we're going to base our currency on the value of oil or gold, and it's going to work well, and these countries don't have transparency, I don't think that's going to happen. But It doesn't mean that the dollar's not going to lose world reserve influence over the next 5 years through a lot of little cuts, which have already started. And a lot of this really started to manifest after Xi Jinping in China last fall, after 10 years in power, solidified his rule with the party Congress. So he could be president for life, like Vladimir Putin is president for life in Russia. The problem with China is they've gone into, around the world to improve infrastructure in Africa, where they pay for a lot of the infrastructure, roads, bridges, or ports, so they can harvest the natural resources that are in Africa, which are tremendous. But when those countries that they go into and loan money to develop these projects don't pay them back, China then seizes the asset. So that's why I've got this last slide for you, which is, China is like a loan shark with no legs left to break. So they're not a good trading partner when they don't get paid back, kind of like the mob. So, but it's going to be a challenge for the dollar. There's no doubt about that. But when a country has world reserve currency status, like the U.S. has had for since the 70s, or since the 40s actually, under Bretton Woods, excuse me. And the U.S. has been a global economic power for over 100 years now. That's usually about the length of the global economic influence. We saw it with Spain for 100 years, Great Britain for 100 years, the U.S. for 100 years. China will be the next global world superpower, and they will surpass us at some point in time, but it's probably not going to be in my lifetime, I hope. But it's coming. They're going to be a
Yeah.
slow-moving train, and we'll just have to see how everything plays out. Now, I'm a patriot. I love our country. I truly do. But we don't get along. Half of our country does not get along with the other half, and they see this, and they know that this is their opportunity to take their shot, and they also know that this is a classic sign of the end of world dominance. When a country starts fighting more with itself than it does protecting its own interests and looking outward to see what their challenges are on the horizon. You know, China has a 5-year plan, a 25-year plan, a 100-year plan. We barely have a 5-week plan in the United States right now.
Yeah,
So
yeah, definitely,
that's
definitely divided.
that's my presentation.
Yeah,
So
that's great. A lot of good info there. I've got a couple questions for you. In terms of, and you briefly talked about, gold versus silver. You thought silver might have a little bit more upside than gold. I work with a lot of investors, real estate investors, but they also like to diversify their portfolios, and gold and silver is a great way to diversify a bit more. For investors that are looking at gold versus silver and really as a storage of wealth, do you have a recommendation on whether they should do gold or silver or a mixture of both?
well, just let me add a little bit of fundamental information to the whole gold and silver picture. Number one, gold and silver are a great way for you to save money, only not in dollars, right? So if you're saving in dollars, you're losing value because of inflation. And gold and silver tend to hold their purchasing power best over time, like real estate does over time. So really, you should think of gold and silver as a way to save money outside of the dollar, outside of the banking system. And you always have liquidity there. Now, when it comes to owning one or the other, gold is true, portable, transferable wealth. 100 ounces is the size of a paperback novel. It weighs about 8 pounds. Today, that's worth almost $200,000. You can carry it in your pocket, and no one would know that you have it, right? Literally. You can carry $200,000 worth of Bitcoin very easily, too, right? But it's volatile, where gold is much more stable. Silver, it takes a lot more volume and size to equal the same amount of value.
I
So
still
you
have
have
my
storage.
quarters here.
Yeah, there you
You
go.
recognize those?
I do. I do. So
I keep them on
you
my
have
desk as
storage.
a reminder.
Yeah, yeah. We'll talk about that in a second. So you have storage problems with silver that you don't have with gold. So you have to think about where you're going to store it, right? If you have physical silver, it takes up a lot more room for the same dollar value. So gold is easy to carry, it's easy to transport, it's easy to transfer. Silver, I do think, has better investment potential, and it's also a much better spending currency in a crisis because a 1 ounce silver coin, this is a 1 ounce silver coin, is worth about $25 right now, $27. A 1 ounce gold coin is worth about $2,000 right now. So you can spend a lot more of these silver ounces than you can in barter transactions if we ever get to that point in society. And that's what silver is really good for. Number one, it has better investment potential. But like I said, it can disappoint for a while before it really rewards you. So you have to be patient. And it does take up a lot more value. But your quarter, let's talk about your quarter for a second. So here's one. This is a 1964 silver quarter. It's the last year the U.S. made a silver coin. In 1964, it'd buy you a gallon of gas. Now, do you have a 1965 as well with you, or a copper nickel coin?
Uh, I do. I do. I have a was this a 1970, but you get the point, right?
Yeah.
The silver one. and the tin zinc one right here.
Yeah, it's copper nickel. Yeah. So in
Copper nickel.
1965, they took the silver out of the currency, right, and changed it to copper nickel. But in 1965, that quarter would still buy you a gallon of gas. That copper nickel coin. Today, this silver quarter will buy you a gallon and a half of gas, where that quarter that you have in your pocket from 1970 or 1995 or 2023 will get you what, a tenth of a gallon of gas, not even. That shows you how
Yeah.
silver retains its purchasing power over time, which is why precious metals are a good store of value. Like real estate, but they're much more easily portable, transactionable, and liquid. Gold and silver
Yeah.
give you excellent liquidity as well, which is the baseline for the metals.
Yeah. Okay. That helps. One last question, and I know a lot of people aren't aware that there's a large period of time in the U.S. history when we were not allowed to hold gold, right? There was a gold confiscation that happened. You can remind us of the years, but do you foresee, let's say we start to move to some sort of gold-backed currency, do you foresee that the U.S. government might confiscate gold again?
Well, this time would potentially be different. So let's talk a little bit about last time to put it into perspective. From ancient times all the way till the 1930s, gold was money and currency. They're not the same thing. Money has value. Currency is something you use to exchange goods, right? A barrel of oil could be considered money, but it's not good currency because it's too hard to use as a transactionable element, right? So gold was money and currency. They took, and going into the 30s, people had a choice between a $20 gold coin or a $20 paper bill. And when the financial crisis hit in 1929 that led to the Great Depression, people didn't trust the paper currency, so they hoarded gold. But FDR wanted to print more paper money than he could produce gold coins, so he confiscated the gold and took the gold out of the currency, right? That's when gold was illegal to own in 1933 because people had a choice as far as spending money in the day. And that remained illegal to own gold in the United States until 1974, when my boss, Jim Blanchard, got that re-legalized following the decoupling of the gold and the dollar peg in 1971. Jim knew that we would lose value to the dollar, so he championed the re-legalization of private ownership of gold and got it done. Today, gold is not currency. It's still money, but it's not currency that we use for exchange. And instead of 100 people having access to it all the time in the financial system, maybe 5-10% of people actually own gold in the world. It's a small percentage of overall people. Most people don't even know what an ounce of gold or an ounce of silver would really look like. In fact, there's, if you go out on the street and offer people a chocolate bar or an ounce of silver, they'll take the chocolate bar. Right? That shows you what people know.
Yeah.
So whether we have a confiscation again, I think, if we get that bad where they have to consider that, there's about 20 other things on the list that would come first. What we're going to get is a digital currency. That's coming. And whether it replaces paper money, which it probably will end up doing, that's a much more big topic. And I'm not really up to date yet on what that's going to mean, but I do know it means that if we have digital currency, they can see everything you do. The government can, how you spend, and whether your spending habits might be politicized or not, just like we have politicized, how we let Russia have access to dollars through our SWIFT banking system. They can do the same thing. If they can put money right into your account, they can also take it right out. So I think
Yeah.
the bigger issue will be, how's a digital currency going to affect everything? Whether they outlaw gold again, I don't know. But gold was only illegal to own in the United States, not in other countries.
Yeah. Yeah, it's amazing. Most people aren't aware of that, but we'll say the digital currency discussion for Mark Moss and George Gammon and Robert Kiyosaki, or Chris Martenson. Those guys have very, very strong opinions on it, as do I. but they certainly have a lot more experience in that than I do. So, but this has been really helpful, Dana. I really appreciate you putting in the time again on the charts. I know it might have been a bit much for the initial viewers, but I told you to stick with us. We'll bring it full circle, and we did. So thank you, Dana. And we'll include your contact info again in the show notes. It was in the beginning of the show on the screen. We'll include in the show notes. So if anybody would like to get a hold of Dana or American Gold Exchange, they can go ahead and do so. He's super helpful if you have any general questions or just want to learn more about it. He's great in that regard also. And he's also a speaker at a lot of these conferences I'm going to. So he's definitely around and certainly can be an asset for anybody who would like to learn more. So Dana, thank you so much. Really appreciate it. And we'll see you for a third time on the CSQ Property Show. Thanks.
All right. Thank you, Chad. Appreciate it. Great to be with you.
All right. All right. I know that was a lot, but I hope we were able to break that down and tell you how the macroeconomics are affecting real estate, interest rates, and the price of gold and silver, and the geopolitical issues that are happening and what that means for the dollar. Please drop us a link below, comment, and subscribe so you see all the future content that we put out on CSQ Properties. Thanks a lot.